What is going on, investors? Hopefully, you guys are doing well out there. On today's show, I've got another subscriber question, and it is a good one. And it is, I would like your opinion if you are expecting a big correction in 2024. Now, I'm going to do this subscriber one better. I'm not only going to give you my outlook for 2024 as it relates to having a large correction in the stock market, but I'm also going to give you my shorter term outlook, maybe over the next 6 to 8 weeks. I'll give you some data points on where I think the markets are heading. Also, some things you can do kind of in the meantime. And then we'll get to the back half. We'll talk about the broader markets over the length of 2024. Now, in the shorter term, over the next 6 to 8 weeks, I repeat, I am absolutely expecting an 8 to 10% correction in the stock market. Now, for a couple of different reasons. I look at the S&P 500. I look at price. That is because we can pick any kind of data point, whether it's government, whether it's a single stock or a single sector, and point to different data points, and it might lead to a recession. It basically leads you to the conclusion that you want to have. Now, with the S&P 500, it's a little more difficult because we're talking about the price action of the world's most valuable and most covered 500 stocks. And so the price action, in my opinion, of the S&P 500 is the biggest and best indicator if we are heading towards a downturn. Now, in the shorter term, like I said, markets are very overextended. We have just approached and eclipsed all-time highs on the S&P 500. Those are areas where sellers tend to step in and you don't have that incremental buyer. You've also had a breakneck rally really since October of 2022, but it's really extended from October and 2023. Just since that time frame, S&P 500 has rallied very hard to the tune of over about 15 to 16%. So an 8 to 10% drawdown in the S&P 500, which I don't call kind of a big correction or something. It's actually something that you should be buying and you should be accumulating on that type of drawdown, would take you to back down to about 4,400 on the S&P 500, would shave about 500 points off the index. Now, what you can do here in the meantime, if a situation like that materializes, which again would just be a continuation of the technical pattern that you've been making for well over a year and a half now, an 8 to 10 correction would simply just be continuing a technical pattern on the S&P 500. So it's something that we're very comfortable recommending if that materializes, you buy. But you are setting stop losses, you're moving your stop losses up, you are taking profits. Again, this goes to our subscriber base that is in retirement or very close to retirement, since preserving capital is of the utmost importance. Look, if you're 25 years old, you're letting your IRA and your 401k roll, there's really no reason to really protect yourself between an 8 to 10% drawdown. But those, again, you in retirement are very valued subscribers in that age range, certainly can protect yourself, bump up those stop losses. Any purchases that you do make, and we're doing this from a recommendation standpoint, very, very tight windows. In fact, we receive criticism when we make a recommendation that the buy range is really tight. Well, it's simply because markets are at all-time highs, and it's in those situations where you tend to be a little more cautious when you're doing buying. Now, as we stretch things out, we look out to 2024, towards the, like we're sitting here a year from now, did we have a 20% correction, a 25, 30% correction in the stock market? Right now, I would have to say absolutely not. There's no data point out there that specifically points to it. There's a couple of data points, in fact, that I think fly in the face of markets having a major drawdown. Number one is if you look at money market data from the Federal Reserve. This is money held in money market funds. A lot of people have been taking their cash and parking it in these money market funds, earning 4.5%, 5.5%. Shoot, I even got a couple of bucks sitting in a money market fund. Those are at record highs. Now, money parked in money market funds is not an indicator that a recession or tough times in the stock market is not coming, but it certainly means that there's plenty, I'm talking about plenty of money on the sidelines to step into these markets if and when some kind of correction does materialize. Also, you get a massive correction in the stock market. Guess what's going to happen? The Federal Reserve are instantly going to drop rates. Those money market interest rates are going to drop down to levels that really doesn't make it worth having money parked in there. And so that money is going to flow out. And where is it going to go? More than likely high yield stocks and back into the equity markets. Now, speaking of money on the sidelines, probably more kind of the speculative side, saw this news actually cross today on a lot of the venture capitalist kind of news sites that I follow. And it's venture capitalists have a record $311 billion of unspent cash sitting on the sidelines waiting to be invested into the new startups and ventures. To give you an idea how big $311 billion is, between 2020 and 2022, venture capitalist groups here in the United States raised a record $435 billion. So $311 billion is not far behind the amount that was invested between 2020 and 2022. So there's a lot of money sitting on the sidelines, not only in very safe and liquid money market funds, but you got money sitting on the sidelines of some of the most speculative investments waiting to be put to work. Now, the last data point that I'll point to, and it's one that probably goes overlooked quite a bit. If you look at home ownership, and that's where wealth is often tied up for most Americans. Yes, a lot of people have money in the stock market, but even more people have equity and wealth tied up into their real estate and into their house. A record number of Americans, to the tune of over 40%, most of them baby boomers, own their homes outright here in the United States. That means nearly every other house that you drive by on your street is actually owned outright. And then if you take the other 60% of people that still have a mortgage on their house, the vast majority of those mortgages are at interest rates that are incredibly low. We're talking less than 4%, in a lot of cases, less than 3.5%. So the real estate market, which really caused the last big recession that we faced here in the United States, the real estate market, while many homes probably a little pricey and maybe in some markets completely overpriced, the real estate market from an ownership perspective and then an interest rate perspective as it relates to people that are borrowing is incredibly healthy. There's a ton of money parked on the sidelines. There's a ton of money locked up into real estate as it relates to unrealized gains and equity. Yes, in the shorter term, over the next 6 to 8 weeks, I do see an 8 to 10% drawdown in the S&P 500, likely again peel off about 500 points on the broader S&P 500. But for a broader market downturn in 2024, I simply don't see anything that makes me believe that it's possible. But obviously, my mind can be changed and situations can change rather rapidly. We'll knock on wood a little bit. But if that situation materializes, we'll obviously be quick to act for our paid subscribers from a recommendation, stop loss, taking profit perspective. But we'll also let you know here on the channel. Hopefully, you guys have a wonderful day. We'll see you again later this week. Bye for now.